It's good. It's good. Yeah. All right. Well, one of the reasons why I wanted to do something with you because I think you've got on the brain like a fucking sponge, and you've got all these data points you put in. I'm not educated. I learnt my craft up and down Walthamstow Market as a an 8, 9 year old, ducking and diving, bobbing and weaving, very entrepreneurial, learning to spot things that others didn't because through necessity because I didn't have a great childhood but it taught me a lot of sharp tools that I honed the skills over years. They were entrepreneurial but in the wrong direction, and then I took that information years later, and then and I have this ability to see what other people don't, if that makes any sense. It's like it's all these data points, and it's in a sort of way. I love listening to what your interpretation of what's going on and what's happened here and what's happened there. But underlying of it, the economy goes on. All right, if things move on, and everyone goes, "Oh, it's going to kill it." Never does. Never does. Everyone adjusts. Stamp duty is a classic example. 2016, everyone's going, "Oh, 3% surge off." Did it stop it? No. Carried on. It's 5% now. Yeah, if you was to go and buy a property in Spain, it costs you 10% of the purchase price on top, right? So people get used to paying it, but there's all these things going on, and I thought it would be great to have a conversation with you to see how you see things and how I see things, because I try and simplify with it because I'm severely dyslexic. So I try and cut. If you give me a spreadsheet, I'm going to look glazed over and think, "Oh, fucking hell," just right away, right? Because to me, it's like, oh, you'd probably look at it and go, "Oh, data, let me pan through it." And so we've got these two. We come to the same conclusion usually, but with different data points. So I thought, what a great way to have these two minds seeing how we see things, and sort of call you out on some of, not call you out, but ask you some of the predictions that you made maybe 5 or 10 years ago to see how they've played out in what's gone on. Because I've got a very unique perspective because I'm a great believer in looking at historical stuff to give you an indication of what's going to happen in the future. So do you want to sort of like I'm recording this, boy. I don't know if you know, but it's been
Yeah, yeah,
recorded.
yeah.
Yeah,
That's
yeah,
cool.
yeah,
That's
yeah.
cool.
So we've got a recording it because we can chop it up and utilize it and stuff like that.
Yeah.
So um, you've got quite an economic background. I mean, you're quite just want to touch on that so people are, if they're listening for the first time, they know who you are.
Yeah, I was the kid who swallowed the calculator and the dictionary in one go at school. Really, like the annoying one who could pass the exams quite easily and all the rest of it. And then my first degree was in philosophy, politics, and economics, in which
Wow.
I majored in economics because I did enjoy the
Mm,
economics quite a lot. Dropped the
mm.
politics after the first year because I didn't think much of it. Not much has changed on that front, Paul, if I'm honest with you. Um, but the philosophy was very interesting. There was a lot about ethics and also about logic, which are two
Mm,
things that have become very important to me throughout
mm,
my property career. And
mm,
then my second degree, my master's in business administration, was
mm,
a 12-month dose of I'd done some entrepreneurial things. I'd had a few years in corporate. I didn't really like it. I didn't really like the structure and the hierarchy. I didn't like the fact that it took you 6 months to get something done where you sat in a meeting and just thought you could do that in 6 hours if you wanted to. You
mm.
just can't
Yeah,
be
yeah, yeah,
bothered.
yeah.
Mate. So it didn't suit me very well. But I had a look at whether I would go into corporate, into consulting. So I do like problem solving. I see
Mm,
property as problem solving realistically.
mm,
If you're going to buy something at a discount, it's not because someone's giving it away. It's because there's a problem that needs solving, as you know very, very well.
yeah.
So that's what I've used my problem solving skills for, really. But I looked at consultancy, and I do a little bit of consulting because I do enjoy it. I think when you can add a lot of value in a short space of time, that
Mm,
keeps me happy. If you've got to then go and
mm,
do the same thing day after day for another 5 years, I ain't going to be interested in that. There's no two
mm,
ways
mm.
about it. So,
Yeah, yeah, yeah.
academic background, very much. I also and whether this is because of what's property's done to me, I don't know. But it
mm,
struck me very early days. So my early days are sort of 2011, going on the
mm,
networking circuit. It was nothing like it looks like today. But you would get a few speakers, and you know what you would get. You would get in between the people who maybe their presentation didn't light up the room, but they had things of substance to say that were important. It might be about legals, it might be about tax, it might be about stuff like that. And then you would get
mm.
these people who like sprinkled magic dust on the room, but they say things, and you thought, I wonder if that can be true. How do you evidence that? And I would
Mm,
always be the
mm.
one asking, not out loud necessarily, but why,
Yeah,
how, so
yeah,
what,
yeah, yeah.
all the simple stuff.
Mm,
And, I got really interested met some great people in those rooms, always have,
mm,
or still
mm,
do. John Cox, who's a mutual friend of ours, for
mm,
example,
mm,
some great people out on the networking circuit.
mm,
But had a sort of a bit of an inkling that lots of people say stuff and they don't back it up,
mm,
So
mm,
I then, as we got into, I was building quite a big portfolio already. We got to the pandemic and the lockdowns came and all the rest. And of course, none of one for the first time in everybody's life, however old you were, you'd never lived through anything like that before. And so you turn to, or at the time, although I've always been a bit skeptical of mainstream media, you turn to what all the big boys and girls are saying, and there's all these terrible predictions. And I just looked at some of them and thought, there's no way in the world that can be correct. Where are you getting these ideas from? Where are you getting these
mm,
statements from? And I
mm,
started rediscovering my love of economic research and things like that. And I thought, there's only going to be one way through this. I'm going to have to do it myself because I can't.
mm,
I can't find a single source that I can trust to
mm,
give
mm,
me. And to be fair, at the time, like many people, very very anxious, huge anxiety levels, not really sure what the future was going to hold. I had a
mhm,
very young family at the time, and
mm,
don't know what world you're bringing your kids up into, and all the rest of that sort of stuff. And I thought, right, the way I'm going to get through this anxiety is I'm going to do the work. I'm going to go and do the work myself, form my own opinions, go out there and be shot at as required, and try and work out what is going to go on. Because I might need to. I'd always historically, Paul, been a buyer. So the opposite from you. I'd always been a buyer and holder, and I used to think, why would you sell anything? And then I got quite friendly with a few traders, and they would speak to me like, "Well, why would you hold anything? You're nuts. You don't want to be a landlord. You're crazy." So I always knew there's a middle ground somewhere, isn't there? And I
yeah,
started
exactly.
opening my mind up a bit more and thinking about whether I would sell some stuff off, and if I'm going to continue to build the portfolio, what would it look like? And
Mm,
really, is it viable to keep building a portfolio,
mm,
or,
mm,
or
mm,
is the shift just against people like me, or do I have to become an institution so I'm on the other side of the fence, or what?
mm,
What does it
mm,
all look like? And then, of course, we got into after the pandemic, change of government, all the rest of it. Big shift, really, because first change of government for 14 years always
mm.
brings more opportunity, like it did.
Yeah, yeah, yeah.
And so, yeah, that's what's sort of driven me down the path where I am today, really, I suppose.
Wow. So it's funny because take the educational background out of it, because I've got none whatsoever. I actually I know I've got a GCE, no, a CSE in metalwork. And I got a B, and I only got a B because my theory was so bad. They marked me down because of the theory, because my practical stuff is right. But I got into this game because my dad said to me, and it's the only sensible thing he ever said to me was get into food, clothing, or housing, and you can't go wrong. And I was a baker. I was on a Saturday job in a bakery, and I thought that's food. That was my career choice. Well, that was it, right? None of this, nurturing, going through university and all that business. My university was the University of Life. And I got sick of baking bread, and it got to a point where I realised that there was no dough in this, so I had to get out. So I remember my girlfriend dumped me because I was going nowhere. Everything in my life had gone wrong, as you can if you could imagine giving a kid the worst start ever. That's the sort of start I had. So it was me. I was jaded. I blamed everything on my circumstances. I didn't realize I had to take responsibility. And then one day I thought, right, that's it. My girlfriend dumped me. I'll get her back. I'm going to buy a flat and change my job. And that was the start of my property career. And I bought a flat in Walthamstow, East London. Um, Bought a really good little deal at the time. I didn't realize I had that ability to buy something cheap. But I was always good at negotiating, always been very good at positioning myself. And then while I was, I actually bought it for 28,000. Shows how long ago it was in Walthamstow in East London, and we sold it within 9 months for 42 grand. So if you think about that percentage, right, that's quite a big lump, to in 9 months. And while I was watching the agent do that, I thought, I was watching, think I could do that, and I ended up managing to blag myself into a state agency. And I went through the boom of the 1980s. And there's a couple of things that happened in the 80s that actually point to where we are today and things that we take for granted. Certainly landlords anyway, right? One of them was the changing of the Housing Act, and the other one was changing the Financial Services Act, which created the buy-to-let mortgage effectively. And I was watching, buy-to-let wasn't very big at the time. I was watching the marketplace, thinking to myself, house prices can't keep rising. Right. There's got to be a point at where affordability kicks in. And what happens then? Well, it played out, the interest rates jumped, affordability was stretched, and all of a sudden you had this massive recession from the sort of 89, 90 onwards until the mid 90s. That was a long, progressive recession, as you remember, I'm sure. Or not you remember, but you'll remember the numbers from back then. Interest rates double figures. There was, and it just shows you the difference, right? From 1990 to 1995, there was 350,000 repossessions during that period, right? And I was an agent selling houses, and I was selling lots of repossessions. And every time I'd ring up a vendor, I'd say, look, your house price has gone down from X to X. Every month it was going down, and it did that for a period of time. But I was good at selling houses, and I realised that selling houses has got nothing to do with economics or anything like that. It's all about psychology, understanding why someone's buying something, why someone's selling something. So I'd focus on the people that needed to sell. And I was watching all these guys get rich. I had some clients that were buying, and they were refurbing in them days. They used to buy them, refurb them, or split them into two flats. And that was the model up until the sort of mid 90s. And these guys were doing really well for themselves. I went for a bad divorce, landed up chucking it in and becoming self-employed acquisition agent working with these guys. And one of them, who's still my business partner today, said, I'll put the money up, let's do a 50 split. Cocked up on something, landed up catching a cold, thinking we're going to lose a load of money, sold it in auction, and I made a big profit on it. And all of a sudden, I thought, well, how did that happen? And that's how I started my career in trading. But the sort of things that I like about ourselves is that we try and predict things. We try and look at the data. We try and look at, like I was back in the 90s thinking this can't continue. There was a formula I used, all right? And that formula was really straightforward, which was I'd look at people's salaries. The average income at the time was X, and you times that by 3.5 times one and once times another. You know there's going to be a stretching point, and you didn't have low interest rates. You had increasing interest rates. So there was going to get a point to which, it popped. It had to, right? And I look back at history and I think, well, I need to look and think where are these stress points, what can happen, blah, blah, blah. And so I'm always gathering what I call, and you understand this, right? We can comb through loads and loads and loads and loads and loads of data, right? You can look at change of governments, you can look at different policies, you can look at, as I said earlier, the policies that changed in the 1980s created the buy-to-let boom. Right, as we know it today, that you had lenders, banks that were coming in and doing mortgages. You had a difference in the housing acts, so you didn't have rights to tenure anymore. All right, so therefore lenders came in and got more confident because they could get their asset back if they needed to. So therefore they did. And then you had the boom times of the up to 2008, and then everyone thought the world was going to end. And then was you involved in? Because you said 2011, you got involved in.
That's right. So
Yeah.
I owned one house. I bought a house in 2001 that I sold in 2004, where I sold my share. I was only a part
Mm,
owner of it. And I
mm,
went to Switzerland for a couple of years. So I was out the market, came back in '06, made all the mistakes you could make, bought a new build, top of the market, wrong partner, couldn't have got anything more wrong. Couldn't have got it more wrong. Interestingly, held on to that, sold that
mm,
earlier this at the back end of 2024, and
mm.
paid 275, sold it for 370, and
Wow.
that was in 18 years. But we did
That's not a lot, is it? Really, in 18
well,
years, really?
mate. If we'd spent that 275 round the corner on one of the secondary market bits of stock, it'd have been 500. So it
Yeah,
just
yeah,
shows
yeah,
you what a
yeah.
new build taught me everything I need to know about new build premiums and everything in one little go. But to be fair, Paul, I got they say it's better to be lucky than good. We had
Mm.
a base rate tracker reversion remortgage, so
Ooh,
that house was getting 1,400, 1,500 quid rent, and it was
yeah,
£100 a month for the mortgage. So
crazy,
we
crazy days.
we've had some money out of it one way or another. But yeah,
Yeah, yeah.
that mortgage would have been the same whether it was a new build or not. So yeah, learned a lot of lessons in one go. And then 2008, split up with that partner,
Mm,
moved to a rental. So I sat and watched the crash from a rental property, obviously
mm,
looking at my own property, but also at the time I was involved in running a betting syndicate or a sports arbitrage syndicate. So it
mm,
wasn't really anything to do with house prices, but it was to do with trading.
mm.
So it was, I've always been, like you said, psychology is so much more powerful than anything.
Yeah,
And just
yeah.
watching what was going on, and I just had this strong feeling around. I mean, I then agreed to buy a property in May 2009, and a property to move into, and you could just feel like it was the time. It just felt like
Mm,
ground
mm,
zero. So
mm,
I had
mm,
done a lot of research at the time. It was
mm,
just the feel of all the heat, and I was looking at properties that had been on the market for 100 grand more a year ago. And
mm,
like you said, it was about finding those motivated sellers. It was because I looked at about
mm,
30 properties. You could tell the people who were just sort of seeing if they could sell it, just I'm not going to bother even negotiating
mm,
with you. There's no point. And I found a couple of people who really wanted to sell and move on. And that got a good. So that house bought for 315 or 320, I think, and
mm.
sold that in 2021 for 575. So just shows you
Yeah,
the
yeah, yeah,
difference in
yeah.
the
Yes, crazy. Yeah.
in the market. So I owned it for less time, made loads more money out of it.
It's funny because in 2007, we felt something was wrong. And I was talking to a friend of mine. He said, "Oh, it's really bad in the States. You want to pay attention to it." And I wasn't paying attention to the States at the time. So I then started watching Bloomberg and then started gathering some information. And the net wasn't as probably as prevalent as it is today. I mean, yeah, Google's so much better than
Right.
it was back in them
RBX
days.
social media, was there? That's the thing.
Yeah,
So yeah,
yeah.
yeah.
So I was gathering data and then realised that this could spill over to because if they catch if they sneeze, we usually catch a cold. You know, it usually happens that way. And so I started paying attention to it, and we interest rates peaked to 5.75 in 2000, and I think it was 2007. I think
I think it was
around
like
that sort of time.
September '07. I think. Yeah,
Yeah,
yeah.
yeah, something like August, September, yeah. And we was paying attention to that interest rate hike, and that was them making buy to let really tight because all of a sudden their mortgages was going up. And people were buying in them days. It doesn't matter, it's part of my pension. As long as it goes up in value, I don't care. I'd rather pay £100 a month into the rented accommodation, right? You know, for the buy to let. So but I remember buying a house in 2007 in Gillingham in Kent, a trading area that we know really well. We've done really well out of, and we paid 100 grand for that house. It was a banger, real banger, and it struggled to sell in auction in early 2008. And I think we made they struggled. I think we made about 8 grand, which wasn't a lot, but it was a shock to the system. It's like, well, only 8 grand rather than normal 15 or 16 at the time. So we knew something was shifting. And then by the end of 2008, the world had gone to shit. And we just sat on our hands, didn't buy a thing. Thought no, we dumped everything, got rid of it all as traders, and then we just had the war chest ready because we knew we. And I watched an article with Warren Buffett, and he said, "Look, be fearful when people are greedy. Be greedy when people are fearful. If you could buy something at 40% behind its perceived value, then it's worth buying." All right. So I took that philosophy, real simple philosophy, and I applied it. And we hadn't been through something like that as a trader because I started trading in 97. We hadn't felt this before, but I'd been through it as an agent. So I knew that I had to be really, really careful, tread carefully. And we bought a house at the end of 2008 in Gillingham. Same as that house we bought. One was in Skinner Street. This one in Gillingham was Skinner Street, and there was another one we paid 100 grand for, was round the corner. So it's exactly the same, apples for apples, right? Same layout, same sort of condition. We paid 60 grand for it. And so I thought, well, that's 40%. What a result. And we started buying stuff around that sort of time because no one was lending. And you had lots of people that wanted to offload. And that was actually a repossession. That we bought a repossession. It's unusual for you to buy repossessions, but banks were so strapped for cash, they chucked all the rule books out the window and were just grabbing money where they could. And it was so bad in 2008 to do the research, and it's frightening, really. I don't know what. It will be interesting to look back at some of that stuff and think what happened to the lenders, because Halifax dumped 400 repossessions in a 3-day sale in Barnard Marcus over 3 days. 400, no reserves, no reserves. All right, they just dumped it. They didn't. And they got sensible money from most of them because obviously you put no reserve and everyone comes out the woodwork, right? And the cash was coming out the woodwork all of a sudden, and we started seeing auctions get. All of a sudden, there was a little spark because interest rates dropped in 2009 to 0.5%. And it was like loads of boots. We filled up as much as we could. One of our best financial years, 09 to 10. We just bought as much as we could. And then we just went on a buying frenzy for the next few years. And it's funny because you was talking about the pandemic, right? I remember the pandemic for me started very early January. And a friend of mine said, "If you've seen that thing in about the World Health Organization stating that there's a potential issue," so it was in Wuhan, China. So I did a load of research because, and that was kind of come back to my point earlier, which was information from information's sake or relevant information that makes a difference, right? So I did research on virology, right, vaccinations, Spanish flu, because that was 100 years beforehand, and what had happened, and the things that as we went into January and February, what other countries were doing, not what they were doing. You saw the on the news, you saw all the patients in the beds in the corridors, and all these horrible scenes. But I was paying attention to what the Italian government were doing for shutting their economy down. How are they going to get things and money into people's pockets? I wanted to know that information because I knew one thing, right? That they're going to have to do something. That there was going to be helicopter money somewhere along the line, because you can't lock down economies because you would literally bastardize everything, right? So I was watching that they were doing, and you could start to predict what we were going to do. And I remember having a conversation, a network meeting in Oxford, saying in a very early March, and I said, "You're going to be locked down, and the government are going to chuck money at this problem," because no one knew what was going to go on. Everyone was, oh gosh. All I knew is the stock we had, get rid of, and then we'll start again once the pandemic come. It was we knew what was going to go on, and we didn't buy a house until June. And then once June come along, I had complete faith that, because a lot A lot of people will look at Boris Johnson and think, what a balloon head. You know, he didn't do this, that, and the other. But he actually, if you look outside of this country, we were the first country, apart from Israel, out of lockdown. We were the first. We were leaders when it came to the furlough scheme, right? Right. That was that the world was looking at us, not the way we saw ourselves. They saw it. Oh, Britain are doing the right things, and people were copying us, right? Because we actually were quite organised when it come to, because it was bedlam. If you think about what you was asking the country to do, and you had to keep the country functioning. So whereas other people saw, yeah, calamity and everyone was ripping everyone off with PPE equipment, you was the last person in line to get PPE equipment because China had nicked it, Austria, Switzerland, France, Spain, all them countries were ahead of us before we could get any PPE equipment. So to have actually gone through it was marvelous, really, if you think about it from a logistical, whole economic mess. You know, we actually come out of it quite well, and we just started buying like crazy in, June, July, because you couldn't get anything through, love nor money, no matter what it was. So if you bought something, it took 3 to 6 months to go through. And then by the time we came out of it, the other side, 21, all the stock we bought in 2020 just gone bang. And I want to, and one of the reasons why I wanted to have this sort of like little podcast here was to think about the perception of what was actually going on, and what led to coming out of it. So you had stamp duty threshold changed, right, to try and boost, and you had a scenario where the terminology of people wanting green space, so they were coming out of London because that caused a boom in prices. What's your perception of it?
Oh, I mean, I think you've just summarised, like, especially what happened in COVID.
Mm,
Having that clarity of thought. And I think you've already said, being through, whether not as a trader or not, but being in the trade, in the property game for what happened in the 90s, and then, 2008 as well. I've been a student of these things from a distance, really. And it really took that kind of, like what I was talking about earlier, that event to say, look, this is obviously we're well outside of the normal curve here. Do you know what I mean?
mm,
Like you
mm.
said, Halifax threw the rule book out, or the banks threw the rule book out the window.
Yeah,
In
yeah.
those times where the rule book's out the window, that's where all the great hedge fund traders and that, if you ever listen to them, how they've made their money, it's
Mm,
same as someone like Bill Ackman, right? He always
mm.
makes money when every story he's got starts with the market went down and I bought something, right? And
Yeah, yeah.
he's a brilliant man, but that's always
Mm.
the story. So that
Oh, yeah, yeah,
what
yeah,
Warren Buffett's 40% off rule,
yeah,
or
yeah,
all of that
yeah,
stuff makes
yeah.
an absolute a ton of sense. And what I find interesting from observing those situations is that people have this desperate need to try and pin it to a
Mm.
previous event, but they'll
That's it.
always
Yeah, yeah.
they'll always do it to the most recent one. Whereas what you were saying, you were talking earlier on about some things being reminiscent of parts of the 80s and the 90s.
Mm, mm, mm,
You didn't say they were reminiscent of 2007, 2008. Whereas
mm, mm,
if we went back to COVID now, you would
mm,
see lots of people saying just like 2000. And I was there on social media posts going, what you're talking about, it's nothing like that. What is the
mm,
same is that we're
mm.
away from the norm. The rule book's out the
Yeah, yeah.
window.
That's it. Yeah.
That's the same. But the results, the catalyst, right?
Mm,
The
mm,
credit bubble or lack of it.
mm,
And
mm,
like you said as well, when you mentioned the critical time when the base rate, I mean, it suddenly dropped in March 2009, but it took them a long time to
mm,
work
mm.
out that it needed to suddenly drop.
Yeah.
Whereas COVID, they realised very, very quickly that it needed
Jumped
to
in
come
there
through the
straight.
floor
Yeah,
straight
yeah,
away.
yeah, yeah,
And
yeah,
I
yeah.
think in fairness, you mentioned about the sort of dawn of buy to let earlier on. In the time scale of stock market, let's say, which has been going in the same way for 150 years, and crypto might not have been around for a long time, but people were overpaying for tulip bulbs in
Mm,
1692 or
that's it.
whatever it was,
Yeah,
right?
yeah, yeah,
And,
yeah,
and it's the same, back to what you said earlier, it's psychology. It's all
yeah, yeah, yeah,
psychology, right?
yeah, yeah.
Whereas buy to let is still quite young. We've only
Mm,
really had 30 years, 35
mm,
years. I mean,
mm.
1996, the first proper, real buy to let mortgage boom really started.
That's it. Yeah,
So
yeah.
we haven't had a lot of time to get used to all of that and what it means. So
Mm,
it's
mm,
still quite nascent in terms of what could happen and what does happen. And I think
mm,
COVID for me was I got there quite early on with the fact that I thought my thoughts were very much around the right. No one's getting any returns on anything. We'd already been through this period of like 1% in the bank and things like
mm,
that.
mm,
And
mm.
suddenly you got to a place where it wasn't one, it was zero. I mean, it was nothing. And they were talking about people putting their money in the bank and getting charged for the privilege of
That's
keeping
it.
it in the
That's
bank.
it. Yeah,
I
yeah, yeah.
mean, this was the uncharted territory bit. And I just thought, there's no way property prices can go down because there's still a real level of return. It's nearly nothing to borrow money. People
Yep.
still rent. People can still afford rent because there's furlough, like you said, and it was a
Mm, mm,
a
mm,
really a clever and quite inspirational scheme.
mm. Mm, it
Um,
was. Mm,
in terms of like how it changed and how it set the pace. I remember being
mm,
surprised when it was 80% because it was ahead of some other
mm,
countries. And
mm,
like you
mm,
said, it
mm,
was it was nice to see us sort of leading the charge on that sort of thing
mm.
as well. Although some bits we didn't necessarily know our backsides from our elbows, you
No,
know,
no, but there
at
was
least
gonna
we
there was always gonna be, again, we're in uncharted waters. What the you need to get money into people's pockets somehow. You
yeah,
need to keep them spending. You need to stop them from starving. And as much as people think he's a balloon head, Johnson made sure that everything was, he was, if it had failed, we'd have blamed him. But we don't give him the credit, I don't think, for orchestrating it from a political standpoint. But one of the reasons why I want you to go here, because I think we have to look back at things that have happened that could have pointed to the boom in the pandemic years. So the classic example is people just automatically equate it to lower interest rates, um, no stamp duty, and everyone want green spaces. What they don't look at is what happened in 2016. And I go back to 2016 because I do remember changing my buying strategy in 2016 because three things happened. All right, we had um, a stamp duty change from the 31st of March that year. We had the Section 24 kicking in that financial year, I think it was, or coming in around that sort of time. It was being phased in, wasn't it? You remember the Section 24 tax?
I do.
Yeah.
So it was the first. It was from the 6th of April that it was the first year that it was being phased in. So
That's it.
20
And
went to 25% relief rather than
that's
zero,
it.
rather than full relief. Well,
And then on top of
75%
that,
relief. Yeah.
And then on top of that, you had us voting to leave the European Union. I don't use the term BRE. I just don't like the word term Brexit, so I don't use that. So we voted to leave the European Union, and what that did, if you look at the numbers, right, and I'm a great believer in looking at patterns, right. So if you look at house price, house transactions over the last 25 years, it roughly translates, because there's peaks and troughs, about 1.2 million a year, maybe even slightly higher than that, right?
Hmm.
Closer
Hmm.
to 1.3 million, right? So if you look at the numbers, in 2016, it was affected by the stamp duty changes because obviously there are a load of people jumped in there to get that relief or before it kicked in. But it was, and it went down on a downward trajectory for the next three years. So that's like 17, 18, and 19. And one of the reasons for that is that you had the buy to let changes, and at the same time, people didn't know what was going to go on with this whole leaving the European Union. And when did we get that point at which we're now left, right? That point of not certainty, but certainly more certainty than we had before, which was December 2019. Now, up until 2016, I predicted it in 2012. I wrote a report saying house prices were going to double in 2 to 5 years. All right, everyone thought I was mad. All right, but there were things that I'd already seen and thought this is going to go, and I'll touch on them in a minute. But it had already gone pop in London, right, and it had gone and doubled in many of the boroughs in London. In that short period of time, and we had stuff in London where the agents will be taking calls saying, yeah, it's on for 350, we'll give you 400, and they hadn't even seen it, and they'd get 150 grand over asking price because that's how much of a boom you had in London. Well, if you push prices in London, what happens is that you get a ripple effect out. And in 2016, that ripple effect slowed right down because people sat on their hands and they didn't know what to do. So they didn't buy a house, right? So you was about 15% down on normal yearly trends. So it was going downward trend, people sitting on their hands. So as soon as we left the European Union, or that was announced, you could tell 2020 was going to be a boom year. I could predict that and say house prices are going to jump in 2020. Well, they didn't need to abolish the stamp duty just to get people to go. They could have left it, it would have gone naturally. But that fueled it even more. And you had interest rates really low. And you had that ripple effect outside London where people were coming out. Everyone equated it to they want a green space. No, they couldn't afford London anymore, so they were moving out. So you had these things come together, bang, and I thought, well, we're going to make a killing here because we could literally predict that was going to happen, along with, as long as we knew what was going to happen with the lockdowns and how financially we were going to be supported. And I don't know if you know this, you probably do actually. Do you know how much the Bank of England said there was in accidental savings during the pandemic years?
I don't know the quantum. I know what the savings rate went up to, and people were saving 25% plus of their income, which is just off, like all COVID
200
grants, completely off the charts,
250 billion of
Yeah.
accidental savings, not normal savings, accidental. So that 250 billion was going to be spent somewhere, right? Along with the restriction of goods and services because you had people in lockdowns. So massive supply chain issues, along with all this money chasing all the goods, which was going to get what? It was going to be inflationary. So you had that, which was going to add to the fact that house price growth, because as you know, inflation erodes prices. Actually, people think they've gone up, but they haven't. They've realistic terms, they haven't. So you had all these. It had the perfect storm for it to go bang. So
Yeah.
that's how I came to it. That was my
Interesting.
interpretation.
Yeah, so we wouldn't be far apart. I mean, my thinking, which was very much inflation driven, was all this money, which started off at being 400 billion, it went up to 600, 700 billion, pumped into the economy. It finds
Mm.
its way around somewhere, somehow. So, like I was saying, I fairly early got onto the idea that lower priced houses with yield wouldn't go down in value.
Oh,
There was
yeah.
no way. I thought that middle back in 2020, I was thinking the middle of the market would probably struggle, right? Which it
Mm,
obviously didn't.
mm,
This was
mm,
pre the stamp duty holiday and everything else. I thought,
mm,
right, there'll be at the lower end, there'll be investment money in there, but people will be scared. They'll stay put. They'll do all of that.
mm.
Completely got
Yeah,
blown out of the water
yeah,
by
yeah, yeah.
2021.
Mm,
Um, but a lot of these, I mean, obviously anecdotally, but a lot of people who had a 50 grand bounce back loan, it found its way into a buy to let somewhere, one way or another.
yeah,
That's, you don't just force all this extra money into an economy and not
Mm,
expect something to happen. So inflation is a broad term. Sometimes, like we've seen over the last 15 years, it might mean asset price inflation, which
yeah,
obviously
yeah,
it did
yeah,
mean some
yeah.
of.
And
But
that's
then,
how I
like I
could
said,
predict back in 2012 what was going to happen in property, because you had what getting on for 800 billion dollars printed, right? In following the financial crisis, I think 750 billion, I think it was, printed and pumped into the economy. I mean, the world economies, they were saying like two trillion dollars across the world pumped into the economy. So,
I think it was more like 20 trillion, wasn't it? All
was it?
told.
It could have been more. Yeah,
I
it might
think
have been.
so.
It might
Yeah.
have been.
Yeah.
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 So we knew that would inflate asset prices, and you had the Bank of England saying to banks, "You can borrow off us, funding for lending scheme, at this much, but you can't. You've got to lend it. You can't hold it." So we knew that would come out into interest rates dropped to 0.5%. And there was one other thing that no one ever took any notice of, right? And this comes down to the psychology. And I always uh, people thought I was crazy, but once you break the 100 grand bracket, generally, you'll go up to, and there was natural restrictions with stamp duty, that, because I think you remember there was 3% over 250 at one stage, not for buy
I
to
do.
let, but for general market, right?
Yeah.
So
Yeah.
everything went up to that 250, bounced up to there, stayed there, stayed there, stayed there. And then once it broke the 250, it didn't go 260, it went 300.
Yeah. Yeah.
Because, there was that sort
Well,
of
those
gap.
were the days where they didn't do it on marginal difference, did they? It was
That's
nothing,
it.
and then it
That's
was
it.
7,500 quid. Yeah, yeah, yeah,
That's
yeah.
it. Yeah.
Pre
So all
twenty
of a sudden,
fourteen. Yeah, yeah.
and once you accept you've got to pay the seven and a half grand thing, it did. So it wasn't a great. So, but here's the thing, right? And no one can understand this at the time. And I was saying, well, once you get past that 250 bracket, you get to 300, and you get to when you start. An agent goes around and values a house. What does he say? Oh, it's going to be worth 301,000. No, he's going to go a bracket. He's going to go, let's try 325. He's not going to say 310. It's going to go 325 or 350. And then as you get to 350, what's close to 350? And then all of a sudden I said, but people be talking about that house has got to be worth 400-500 grand. Where did the 100 grand come from? So you knew 10,000 is 100. You knew five is 50. And once you've got that in their brains, lenders accepted it quite quickly. People started talking about 4, 5, 6, 7, and all of a sudden, what's us 100 grand? So you had that psychological change as well, along with all the other things, which was to go boom, and that's what happened. So these are the sort of things I look for, because and there's another thing I'll talk about in a second, which really, I don't know how much time you got, but which I think you can predict the next decline.
Interesting.
What's your take on what could happen in the future?
Well, there's a couple of people who I've heard say over the last few months that they think house prices could go up significantly, could double in the next 5 or 6 years, because stuff like this.
Mm.
My own analysis says that we're well below the inflation adjusted price of housing for the last 20 years. So
Mm.
there's all
Mm.
this stuff about stuff's unaffordable and blah, blah, blah. Yeah, and I take your point about affordability in the 90s you were talking about. The point that I make is that it's different from the 90s because you've got more incomes per household than you had back
Mm.
in the 90s. So you can't look at the average income. You've got to look
Nope.
at the average household income. And in the real world, you've got to
Affordability.
look at the
Mm.
average household income of a
Mm.
homeowner and the average first
Mm.
time buyer household
Yeah.
income,
Yeah.
which is up in the sort of 60 grand sort of category.
Mm.
So an
Mm. Mm.
awful lot below 300 is
Mm.
eminently affordable for most of
Mm.
the country. Um, Rules get different when you get to London, as you know
Mhm.
a lot
Mhm.
more about than I do. And you can still buy some cheap stuff in the southeast if you're not so fussy where you live.
Mm.
But I think I take. I mean, I'm bullish over the next 5 years, not to
Right.
the tune of thinking doubling in value, but there is a chip on the table that we don't know what's going to happen yet. And that
Mm.
is whatever is going to happen around changing the credit requirements for a mortgage. So the
Yeah. Yeah.
affordability breaks.
Yeah.
We've had the noise from Rachel Reeves. She
Mhm.
said
Mhm.
she wants the FCA to look at it.
Mhm.
And they know in the real world, if they can get house prices moving by about year 3, year 4 of this parliament, they'll get elected. It's a guaranteed
Yeah, it's
re-election.
guaranteed. Yeah,
Right?
yeah, 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 yeah.
Now, I
Okay.
don't know what you do in the second parliament in order to avoid a boom and bust cycle. And I don't
Hmm.
know if they know that either, to be honest with you, Paul. But they probably won't be thinking past the next election date at the moment because that's politics for you. So, how much will the brakes come off? I think we probably did that thing you inevitably do when you have a financial crash. We probably went too hard on the brake and we
That's it. Yeah.
stayed there for a
Mm,
long time. But like you say,
mm,
we were pumping the QE was coming into the economy. It's now
mm,
draining out a lot more slowly than it went in.
hmm.
But a little bit of a credit boom. And look, at the end of the day, even though all this fuss about interest rates and stuff like that, as we're talking today, you can still get a Best Buy mortgage under 4%. So
Yeah.
it's very affordable. It's very
Yeah.
historically very affordable stuff. So it depends how much it goes up and how quickly before it goes down. So I don't know if we'll see a compressed cycle here. But
Mm,
what it's a bit like inflation. Once you let the genie out of the bottle, you haven't got control of it anymore. So if they
mm,
do accidentally on purpose, start a bit of
mm.
a credit boom, will
Mm.
they be able to control it when they get past a certain point?
That's it.
Your
Yeah.
everything you've said so far suggests probably not, and I'd agree with that. So it is possible that in 5, 6, 7 years' time we could have a bit of a wobble.
Mm,
Um, a blow off top, as a stock trader would call it, something like
mm,
that.
mm.
Um, we've got this inflation in the background as well. I believe we live in a 3% inflation world these days. I think that's where we are
Yeah.
for the next 5 years, if not
Yeah.
more. So that
Mm,
drags prices up anyway.
mm,
So how much of it is real terms growth, and how much of it is just inflation fueled growth? That makes a bit of a
mm,
difference. But yeah, we're just doing what people do when they change laws. We put the brake on too hard. We probably take the brake
mm.
off too much. We're swinging around the middle a little bit. We'll see how we go. What do you think?
Well, there's a couple of things that I look again. I look to the past to give me a sneak peek into the future, and I look back at my very first mortgage in 1986, and the interest rate was 14.5%. Right, I was spending close to 50% of our net income on a mortgage payment. Because people talk about, oh, it's easy for you back in the 1980s and 90s, where it wasn't, it was hard, right? Today, the average percentage of their income paying mortgage payments is around 22%, right? And the average rental is closer to 40% as far as their income is concerned. So I think there's a lot of elasticity in the property market, but you've got some factors that are making it going to be making it more difficult for people to rent in the future. There's two reasons for that. One, landlords are exiting on a big scale on the traditional buy to let units, right? They're getting rid of them, right? And they're coming over to multi units, HMOs, which if you're a young family, you go and rent somewhere, you're not going to take a HMO, you're going to look for an individual unit. There's less of them. It's more expensive to buy, sorry, to rent and buy. So, and if as they lax the lending, i.e., the affordability changes, you'll start to see these quality tenants come out the market and start buying. And they'll be hoovering up them little landlord properties that have been selling out, the two up, two downs they've been living in, but they'll be buying them in the future. My concern is this. We're very similar to the 1970s where we had high inflation, but we had substantially higher interest rates. Inflation 23%, interest rate 17.5%. It peaked in 79, right? When people forget that, right? We think we've got it bad, but there's similar times. And house prices doubled in that decade twice. They went from 4 grand to 20 grand in that decade. Why is the question I asked myself when you had high inflation and high interest rates? And there's one reason and one reason only. And when we track it, we can then start to predict the next bust because It didn't bust in the 70s, but it busted in the 1990s following what? A period of lax lending. And then in 2007, up to 2007, a period of lax lending. Well, if you've got too many people that have to sell at the same time, i.e., repossessions, can't afford it because you've lent to the wrong type of people, that then follows a crash in the market. Right, it happened 80s, 90s. 90s was a bit slower. It wasn't as dramatic because the 2008 was more to do with no funding around and loads
Yeah.
of repossessions, as opposed to a decline. They went up in 33% in 3 months in 1988, and they lost that 33% over the next sort of 4 or 5 years. But you followed a period of lax lending, right? So more people have to sell at the same time. This time round, and as in the 70s, if you wanted a mortgage in the 70s, you had to invest with a lender because there was a mortgage famine. So you had to put all your savings with the Leeds Permanent Building Society for 6 months or a year. And then over that period, they would then say, yeah, we'll grant you a mortgage as a money funding. So you had a really stringent lending, exactly what we've had in the last 15 years. So anyone that's borrowed in the last 15 years who's got skin in the game, they're not the type of people that are going to let their asset go. Even if the interest rate doubled in the next 2 years for them, they'd hold on to it for dear life. It's probably gone, it's more worth more than they paid for it in the first place. They've got lots of equity. So they're not going to let that asset go. And even if they did, where could they go and live? They'd have to go into a shitty old rental. So they're going to hold on to the asset. So if they relax the lending enough in the next few years, it's going to fuel one, loads of people coming into the market and pushing that asset prices up even further. Right. And then along then it gets to a point at which it could bust in 3 or 4 years. So that cycle you're talking about, exactly what they're going to be doing. They're going to be manipulating the FSA. You're going to get that 20 to 50% push from, and that's the cycle that you start worrying. Then when you see 20 to 50% going on house prices, you start to think, where are they going after that? They might double. I'm not as bullish as doubling, but certainly 20 to 50% could go on if you saw lending a lot laxer than it is now. But it's not going to crash if that doesn't happen. It's going to stay stable. And the other thing as well is, as people are coming off their rates and getting 4% or 4.5%, whereas if you was in a nice three-bed semi, your next jump was from 400 to 600. You would have bought that nice, small, detached, boxy executive home. You're looking at your current mortgage, and the actual new mortgage is going to be or just as expensive as the new one you would have purchased. So you just stay put. You don't move. So there's less stock on the market to cause a problem. So you've got that to factor in as well. So I think it's fairly safe. I think the biggest concern I have is distressed landlords. I think, yeah, I'm seeing lots of stuff come through auctions from insolvency practitioners that are taking people's portfolios back and releasing them a few at a time. They don't just dump them on the market, they're releasing a few at a time. If that gets more momentum, that could cause a little problem, not much. And so that's where I see it anyway.
I think that's very sensible, and I think we should probably be quite open to what the upside could be,
Mm,
because a lot of it also depends on. I mean, affordability's improved quite a lot in the past,
mm, mm,
18 to 24 months, really, because wages have moved up, house prices
mm,
have moved sideways. There've been
mm.
fairly chunky increases one way or
Yeah,
another.
yeah.
The thing is, the part of the problem that the renters have got, and I think you've touched on a lot of the good points as why the rental stock's struggling. from what I
mm,
see at the business end of as a holder of property as well,
mm,
is that more
mm,
and more people are being seduced over to leasing property to registered providers as well. So that's taking
mm.
more units out of the
Yes, yeah,
market.
yeah, you're right. Yeah, 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 yeah.
And the Renters' Rights Bill probably pushes more people into the bracket that need help,
Mm,
and takes more units out of the rental market as well. Because if 1 in 6 or whatever I heard the other day, renters can afford to buy, as you said, some of them will choose to buy. They won't want the
mm,
flexibility anymore. But your average renter is earning, private renters earning 35 grand a year. Your average homeowner's earning 60, like we said. So the
mm, mm,
percentages can't necessarily be, because 20% of 60 is the same as 40% of 30.
mm,
And that's
mm, mm,
part of the
mm,
problem. Part of the
mm,
problem the renters have got, plus the deposits and everything else.
mm,
And
mm.
it's quite difficult. But even with 100%, they reintroduced the 100% mortgages, didn't take off, did it at all?
No,
With
no.
skips, and
But
it just
you watch it change, and I'll tell you the way you watch it change. And I look back at my own experience when I first went out to get my girlfriend back all them years ago, and I decided to buy a flat. The only reason why I decided to buy a flat at the time in the 1980s, prior to all the changes with the Housing Act and the Financial Services Act, is there was no rental stock, so you had no choice. So as you reduce that choice for people, they're going to have to buy, and they'll find some way to beg, borrow, steal to buy a house. Because I, in fact, I remember my family saying, "You're going to buy a flat." I mean, none of my family owned properties. My nan did. But the rest of my family didn't own property. It was alien to them for someone to buy something in the 1980s. So I think that could change. And I equate it to my own kids. Both my kids have bought properties, right? And but what my stepson, when he was looking, he wanted that flexibility, so he chose to rent for a short period while he built his business. He said, "I don't want to put the money into a house because I was building my business," and he did the right thing at the time because his business is very successful now. But when he went to rent somewhere, then he realised, oh shit, there's not much quality stock out there for a young family that want to rent somewhere. So his first purchase was 550 grand. The equivalent buy to let in the area would have been a house that cost 200 grand. You can imagine the difference between the two. I'm not renting that. So he had no, in fact, he moved in with me for 6 months because he didn't want to rent the trash that was out there. So he was forced again into buying something because the stock he wanted wasn't available. So I think that will come more prevalent as you see a change of landlords scrapping for maximising their rents, whether that be social, the HMO or the SA or whatever the case may be. There's a big gap, and that's going to have to be filled, and they'll come away and they'll start buying. So
Yeah, I think we're on the same page on quite a bit, aren't we? It'll be
mm,
how much the brakes come off and when it happens, and how long it takes to really bite as well. And whether, I mean, I suppose we've got a few. Anything could happen in the next election, apart from anything else. We could have all sorts of different governments coming in.
yeah,
That could
yeah,
change a
yeah.
few things. If house prices do move, as we sort of speculated, you probably will see Labour hold on, and
Mm.
it'll keep things. It's how they manage from. Well, they won't have done their 1.5 million homes. I think we all know that much. Whether they'll have another bite of that
Ambitious.
cherry, they're still. It's still highly unlikely they'll build enough houses to deal with the net number of people coming into the country who want housing. Like I say, and I can never find, Paul, you mentioned about HMOs, but I really struggle to find good statistics on whether HMOs are growing in number or decreasing, because the
Mm,
circle we move in, it's surrounded by people creating beautiful,
mm,
lovely new HMOs with mustard
mm,
cushions and everything else. But the official stats that I ever see are always saying we're seeing fewer HMOs as well. Whether that's
mm,
people getting
mm.
rid of non-compliant, horrible old things that they've got away with
Yeah,
for 20 years, I don't know.
probably more like yeah, yeah,
Yeah,
yeah.
Well, when I look at the shared room rate and I think how the LHA rate's put together, and I see I'm the guy who goes into the source data. Do you know what I mean? And
I can imagine, yeah.
I look and I think, blimey, who's charging £50 a week a room? But there's still people doing that in 2025. Um,
Yeah.
and you just can't imagine. You know what the standard will look like as something like that.
Oh God, yeah, yeah,
It'll
yeah,
be bad. But yeah, I
yeah.
mean, HMO seems the only sensible way forward. If you're not going to build enough, you've got to chop up what you've got into
Mm.
to house
But
more households.
my concern is, providing bar providing a service to, the council for the emergency housing, or for asylum seekers and stuff like that. Every time you do put one unit in, you've got 5 to 6 units, not one, like a buy to let. So you can saturate. And it's funny because someone asked me about Gilliam. And who wants to do a HMO in Gilliam? I said, don't. There's an oversupply of rooms. And whether they're good quality or bad quality is irrelevant, but it's just an oversupply, because you can go into spareroom.com and say, you could do either find or
Who's
see.
looking, who's supplying? Yeah, yeah, yeah,
Yeah,
yeah.
yeah, and you see there's an oversupply, as opposed to some areas where it works really well, where you get the higher end. Is usually areas where you haven't got a lot of HMOs. They're not traditionally done, and I've got a couple of older mates who have been on their ass, not done very. It just they've got divorced. They can't afford to buy another house, and they've landed up in a HMO at sort of 50 years of age. There is a demand for that sort of
Yep,
stuff.
yep.
But you can easily oversupply a market if you're not careful. That's my concern with that. Do you ever? What do you see the biggest risk to the economy generally across the globe, or things that black swan events that could catch us a cold?
Well, it's interesting, isn't it? Because there's a lot of talk at the moment about how much debt there is in the world, without anybody really being able to put their finger on. There isn't this event horizon that suddenly you get to 100% of GDP or 130%. There is no event horizon on all of that. And people like Japan, interesting. I was reading about Japan this morning.
Mm,
Their population's down about 5 million in the last 15
mm,
years. And although their growth
crazy.
rate is below ours, their growth rate per head is actually pretty reasonable. So
Mm,
they've gone
mm,
about it in a certain way. So low growth is a problem because it
mm,
makes it a lot. It's quite easy if you've got a big company like Procter and Gamble, let's say. All you need is more people to sell your products to, and you just grow anyway, right?
yeah, yeah, yeah,
Same
yeah,
as the
yeah,
UK economy is growing, not because it's
mm,
doing well, not because it's becoming more productive. It's just getting more people
mm,
in, and so more
yeah, yeah,
people
yeah,
together are doing more. Although
yeah.
it doesn't help per head, and that
No.
doesn't help with social unrest and all the rest of it. So
Mm.
that is a problem. But debt wise, I mean, look, a debt shock to the upside would be a very difficult thing. So if we got someone, look, over the next 5 years, we've got another election coming, right?
Mm,
And there's a lot of it, but before that, there's a lot of elections in Europe that are coming
mm,
in economies.
mm,
When you were saying earlier about the pandemic and looking at Italy, and
mm,
we could see
mm,
what was coming and everything else. Same goes with the politics, right? So
mm,
we could
mm.
see some really salty elections over the next few years. And now, one
Yeah.
of the things that might happen is that they might lose control of their bond yields and their bond markets.
Yeah.
Now, people who are in the EU with the European Central Bank will be somewhat protected, although Germany will stamp their feet a little bit. But we're in a position where we're really quite small these days on a
Mm,
global
mm,
scale.
mm,
And if we
mm.
got a reform elected on the strength of a manifesto that looked like their last one, we'd have a
Mm.
big economic. You'd have interest rates at 8 or 9%,
Yeah,
and
yeah,
that
yeah.
would cause some of the problems that we've talked about over the
Mm,
course of
mm,
this
yeah,
last
yeah, yeah,
hour.
yeah, 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 yeah,
So
yeah.
that's so geopolitics, but maybe just national politics is definitely a bit of a risk.
Yeah.
But otherwise, the direction of travel, all this like corporate ownership, it's very clear. It's relentless to be.
Mm,
All we
mm.
can do between ourselves is name reasons why people will take stock out of the market, and the only reason
Well,
people will buy it is because it's cheap.
I
That's
think
the reality.
my only concern would be something like, and you've got people who are hardcore on this and don't think it could happen, but you could have a collapse in something like crypto, Bitcoin, or something like that, where that has a ripple effect on everything. Because I think I see correlations to the 1920s where you had stock market prices going up because people believe it's going to go up, 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 and it goes up and it goes up, and then you get banks stepping in legitimizing it, which is they're doing now because they're thinking, well, let's do a trading platform. We're missing a load of money on the table here because if we had an exchange, we could, make some money out of this. So it looks like it's legitimizing a Bitcoin as a currency when it's not. It's just, let's make some money out of this. And then banks then go, well, or brokers like, yeah, we'll give you some margin on it, and they start lending against it because it goes up, don't it? It goes up. It's that fool's gamblers, scenario where no one thinks they're going to lose, and then all of a sudden the price drops substantially. Don't know if it will go to zero, but it could drop substantially, and then everyone's, oh shit, what's going on? And that has a ripple effect similar to 2008, where it rocks the financial system and everyone goes, pulls back.
Yeah, I wonder. I wonder if it would depend who was taking the losses, wouldn't it? Really, because
Mm.
what
Well, so
crypto broke.
your ordinary punters are getting involved. That's the problem. And they're borrowing money on credit cards, and then you'll have,
Yeah, that's your 1920s, isn't it? Retail punter on margin, but
yeah,
then in the
yeah,
20s they were getting 10 times margin on stocks.
yeah,
And whether and
yeah.
how much, I don't know how successful you can be getting money from credit cards into crypto. I'm sure there's clever ways to do it, but they try and stop you, don't they?
I think it will be the exchanges that get really cocky because they think it can't lose, and they'll start lending substantial times.
Mm.
It'll be them, and they're behind it as a bank. Because they, what it's like. If you go back 15 years, the people who are in charge are no longer in charge, so they don't remember what it was like in 2008. So they relax things, and
Oh
before
yeah.
you know it,
Well, plus
you've got. So that's why.
they base themselves in jurisdictions where the laws are different, don't they? Apart from anything else,
Yeah,
so
yeah,
the
yeah. And
FCA or whoever in the states hasn't got any jurisdiction.
yeah. And when you get someone like Trump come along and trying to legitimize some sort of crypto, he's got 4 years in there. The next administration might go scrap all that, and then you've got what, it could have gone up to 200,000 per
Yeah,
Bitcoin. And then to drop from that to 100,000 would be quite devastating. So that's the only concern I have, because there's no use case for it.
no,
Realistically, it's not
no,
like
I agree with you. I agree with
it
you.
is a speculative tulip
It, it,
scenario.
it
In a way,
directly impacts the stock market because you've got companies like MicroStrategy who are holding an awful lot of Bitcoin. Yeah, yeah, I
mm,
think, and as you said earlier as well, psychology. So far we've seen, although it's supposed to be this sort of the antidote or whatever. When the market does drop in a fit of panic, crypto drops as well.
yeah,
It's
yeah,
moving with
yeah,
the market when there's volatility. So,
yeah.
but we haven't seen it start a problem yet. But of course,
No, not
the
yet.
market cap's growing and growing and growing. And with it, like you say,
Yes,
with a Trump coin, I think the Argentine president has done his own coin now because he fancies to get in on the app with his chainsaw or whatever. It could cause, and it's confidence that it rocks, isn't it? That's the thing. But seeing
that's
something,
that's the thing. Yeah, yeah,
and it is possible that the event horizon of someone. I mean, one of the things I was talking with someone about the other day, these quantum computers, it might
mm.
well be they're not far away from being able to break the encryption. Well, that makes it all
It's
worthless
relevant, yeah.
overnight.
It's worthless, yeah. It's crazy, and I think that's the concern I have is that you saw Sam Bankman Fried a couple of years ago. How many billion did he? 100 billion, was it? I don't know.
It was it
Crazy
was tens of
sums.
billions, wasn't it? Yeah, tens of
Yeah,
billions. And the
it's
ripple
crazy
effect,
money.
like you say, he hurt the
Mm,
whole of the crypto market with what happened to him. you
Mm,
know.
yeah, so I think that concerns me, and there's other things that concern me, and I think you got a valid point. I think you know what, all that blustering with Trump and his tariffs. That's just a blunt force. It's a blunt force trauma, which is I'm going to bash you over the head unless you. He has no intention of putting 25%. He knows it's going to kill the economy. He's just using it as a blunt negotiating tool, which in a way, it's what Boris Johnson did. What Theresa May wouldn't do when he put the gun on the table for the European Union and said, "Well, I'm prepared to use it." He put whether there was any bullets in the gun is a different kettle of fish, but sometimes that threat can be a great motivator. So I think as much as he's stirring things up, he'll get NATO, countries paying into NATO to make sure that it firms up. So I think he's getting things, as much as I don't like him, it's doing something. How far he'll go, I don't know.
Well, yeah, the idea of, I mean, the thing is, you can't really be, the whole Ukraine thing is interesting because they're not going to roll over and accept the solution that Trump, and they never were, and
No, no,
he's
no.
outside of his remit there, and he does look a bit to an observer, he just looks a bit weak, to be honest with you, and it's a bit strange. So I haven't figured out his end game there, but with the whole
Yeah,
like
yeah,
Greenland or the tariffs or whatever, like you said, you can see what he's trying to achieve. You start here. If you end up here,
yeah,
you're okay,
yeah.
and
Yeah, yeah,
you
yeah,
thank him afterwards and shake hands, sort of thing. But
yeah,
yeah,
yeah.
I'm not sure all of it is a perfectly thought out strategy,
No,
but
it's not. No,
it's quite interesting to watch. I know that much because
yeah.
there is
Mm,
a few lessons in negotiation there, but you can only go to the top level with the if you're in a negotiation, you just go full hammer every time, every day. It's not going to work a lot of the time. He's not going to be able
no,
to
no,
tell us
no.
to spend 5% of our GDP on defence. The people don't want it, and they're not going to
Yeah,
stand for it.
yeah.
2.5%, fair enough. After it, we're going to get to the
He went.
stage where
Didn't he say he wanted 3%? Was it? Did he ask for
he
5?
wants us to work towards 5%. He said,
That's crazy.
but
But again, if you get, because we're one of the countries that do pay in regular. I think there's a lot of
we're one
countries
of
that
the
don't.
few who were doing our bit, and we were
Mm,
already
mm,
announced to go from 2 to 2.5, and we're
mm.
working towards it. But the obvious hook behind that is he wants us to buy from the big American defence companies. It's as simple.
Yeah, and that might backfire because they might say, "Oh yeah, for the time being," and then over time, think, we don't want that gun over against their head. Let's look at alternatives because that's the danger of tariffs: is you get what you want now, but it's like the Ukrainian with the gas from Russia. People start looking at alternatives, and
Yeah,
then eventually the threat's gone.
yeah.
And he'll have
That
nothing
takes
to
12 months to be
bash.
bringing in your liquefied natural gas from Qatar or whatever. Yeah, yeah,
Yeah,
yeah,
yeah,
absolutely.
yeah. So I think there's lessons to be learnt from that, but he's not looking at that. He's just, I'm the negotiator. I go in there and I bash people over the head, and that's what he's doing. But I can't see any major threats from his administration, even though I just think what he says and what he does. The Doge thing bothers me a little bit, but I don't know how that could play out, but we'll
Yeah,
see.
I think if
It's
you look back at like when we did austerity, right,
mm,
you would
mm,
probably find very broadly that the first round of cuts was well justified and saved some money. The second round of
mm,
cuts probably pretty effective, net positive sort of effect on the economy. The third round and beyond, all it did was kick the can down the road, move numbers on spreadsheets. And when you get to your sixth or seventh round, you're actually making it worse because, like you just said,
mm,
you're doing
mm,
stuff today that in 5 or 10 years' time is going to end up costing us. It's a bit like in COVID when they decided they closed the primary schools, right? It's a
mm,
terrible
mm,
decision. Yeah. It's a
mm,
terrible
mm.
decision that'll have a generational impact. And we're
Yeah,
seeing
will
it.
do. Yeah, yeah,
More
yeah, yeah,
kids not
yeah.
going to school, more kids not being able to use the toilet, more kids.
Mm,
It's a horrific fallout from
mm,
all of that.
mm, mm,
And
mm.
you can't do things, but that's politics for you. People do things now
Yeah.
and eyes for the next person to worry about, sort of thing.
Yeah,
It's like,
because everything is because of your tenure for the next 4 or 5 years. So
so,
you're not thinking long term. You're thinking very, very short term. And then someone comes along and goes, "I'll scrap that." HS2 is a classic example. Part of that scrap it should never have been. Just leave it, because it's going to add to the economy some way, shape, or form. Even though it looks, I get on the high HS1 from down here in Kent. Takes me like 19 minutes to get to London. I've got people who live close to London, take 40 minutes to get into London. And I'm jumping on that train. And they said it wouldn't be financially viable. It's 30% more expensive than a normal journey, but it's packed. They had to put
yeah,
more carriages on. People were prepared to pay for that service. So,
yeah.
it